All right, good morning, everybody. This is the last full week of trading. I was looking through some put call data, and we have triggered into never before levels of put call. And it's all front end, and it's all very violent. So we don't have a lot of speakers on deck today. And after we get through the morning session, we should be done with any economic reverberation. So the afternoon trading should be good for a 0 day. The inflation data that we're going to get this morning is supposed to validate the Fed's decision to reduce the size of their rate hikes. So could be a little bit of a surprise if it doesn't come in as expected. But we're not expecting, the kind of morning that we would see, say, on a CPI day, right? It's not expected to be that big. The dollar is down a bit, and the VIX is flat or muted. We're really range bound, kind of tight this morning. S&P and the NASDAQ both, near a 0.25%. The rig count should not be an issue. I mean, like I've mentioned before, that's what I did for 20 years to work on those rigs. You don't normally get a real large change in numbers unless something drastic happens. And there's no expectation that anything drastic has happened. So the rig count should not be an issue. By 10 o'clock, all the economic data that we're going to have, we should have, and we should be good to go at that point. Now, this kind of indicates that perhaps the economic information that's going to come out this morning is going to be taken a little more seriously than normal, right? Some days the econ that we get is more impactful than at other times. So while I just said shouldn't be that bad, volume is suggesting it might be pretty bad. So it's one of the reasons we use this thing. It's cumulative overnight volume. We're basically taking a look at the average trading volume on a day-to-day basis. If it's below 100 at 7:30 in the morning, we want to take a look around and see why everybody's standing to the side waiting and what they're waiting for. when we know what it is, it's not a big deal. You know, if we come in and it's CPI day and the volume's really light, yeah, that makes perfect sense. So today we've got morning econ that normally should not be extraordinarily impactful, but the volume says they're waiting on it. And that means could be a little more volatility than normal. So a little bit of a heads up on those time frames. Circle right back into them again. 8:30 and 10 o'clock. It would be the 8:30 numbers that very likely is going to be the most impactful. So watch the clock at 8:30. It's my mantra anyways, watch the clock. This is a very narrow range. If you consider the IB, then it's even more narrow. The IB would be the first 1 hour from 6 o'clock to 7 o'clock last night, the highest point and the lowest point within that hour. It's exactly like an open range that we would do in the RTH. The only difference is with a normal open range, you can choose whatever time frame you want. You want 5-minute open, 15-minute open. But with the IB, you don't get to choose. It's set at 1 hour. And that is a very narrow 1 hour open range, an IB, initial balance. We didn't get a move through the kill zone, but we did start to see everything beginning to pick up around 4 a.m. Now, it's important to recognize where we are at in relation to yesterday, because the idea that we could get an inside day breakout would have to be directly connected to the idea that we're going to travel so hard and so fast that we're going to be able to break out of this range and then expand beyond it, up or down, doesn't matter. We're basically sitting in the middle. Now, when we think about this from a daily candle perspective, 50% of the move is really important. All right, we can see the 50% retrace here from the fib line. When you have a big day, you want to measure that candle and mark the 50% line. Price should not retrace and close above that 50% line or below if you're going in the other direction. If it does, then it calls into question a continuation in the same direction. So, you know, we traveled to the downside, pulled back as we came into the close. If we were going to continue the move to the downside, it really should not get above that 50%. Now, technically, we're still in the pre-market. We're not into the cash session. When we talk about close above, it's got to match the time frame that you're looking at. We're talking about a daily candle. So we would want to be discussing it from, you know, a daily chart perspective. But we're at that 50% mark. So a little bit of a takeaway from this is if we cross through that line this morning and we continue to move farther away from it to the upside, then it shuts down that whole we're going to continue lower argument, right? And it doesn't mean that we can't anyways 2 or 3 days from now. Just that's going to be the starting point for everything else. $38.53. We keep coming back to 38.50. A couple of pennies one side or the other doesn't really matter. All right, so we got that one. That's a critical pivotal level you want to keep track of, above and below. We have an ADR greater than 2%, and we have a market maker move this morning. So we want to add these two together. We'll just round up and say 80 points and 33 points. So a 113 point move from right this moment, right? We use the ADR from the close or from the open. But when it comes to market maker move, it's really from our current location. So you can get a little wild with the math. I generally just like to do everything from the Globex open. The ADR full is 39.29. And if we were to add beyond that, another 0.86%, that would basically get us up to 2.92. $39.60. For the downside, 37.38. Now in high volatility markets, we can travel farther in a single day than in a normal market. All right. Volatility is the nerd word for movement, and implied is another way of saying promise. So implied volatility is promised movement. It's an expectation that we're going to see greater moves, right? When we're not on an options chart or an options chain, volatility is directly connected to candle close to candle close, where this candle closed in relation to yesterday's close. That's the distance that's being measured for volatility. So it makes sense in a high volatility environment, you're seeing a greater distance from one day's close to the next day's close. You see how when we strip away all the fancy bank talk and just put it down into plain English, it's not so complicated after all. In a high volatility market, you're generally going to see a close from one day to the next farther apart than you would in a less volatile market, right? Go out to a daily chart. A bullish chart generally has small uniform candles, and a bearish chart has big gigantic candles. Simple and obvious. We've hit some numbers this year that have become almost common, like a 3% move. Well, we measured out almost a 3% move here. It's 2.92%. You take it a little bit farther and add some extremes today, because we do have the capacity today to go a little bit more, to do a little bit more. So let's do a 3.5. It may seem arbitrary, but we're not just pulling these numbers out of thin air. If you go back and look, when the S&P gets wild, as it has a few times this year, it still generally lands on a round percentage, 3%, 3.25%, 3.5%, 4%. And that doesn't mean that it's got to be to the tick perfect 3% move. It could be 2.97 or 3.04. It doesn't have to be exact, but it's going to get you in a ballpark region, right? It's going to get you close to where you need to be. So that would be our mildly extreme level. When we get beyond that, yeah, start looking at 4% moves. We can do it, but you got to remember half the trading day is already done. We get 23 hours a day to trade, starting at 6 o'clock last night, 22 hours. So we've already used up a lot of that, right? More than 12 hours of the day is gone, and we only have 22 hours to trade. So there's 10 hours left, less than 10 hours, right? To make a 3% move in 10 hours or 9 hours, sure, we can do it. But oh boy, would it be extreme, right? Now, yesterday wasn't extreme. Yesterday was good, clean, beautiful price action. Consistent, persistent, nonstop. Even had a little bit of back and forth to it. Wasn't easy, but it wasn't extreme. Kind of keep in mind the idea that this is very controlled selling. This is clean and orderly. This isn't fear. It's not chaos. We haven't even begun to get into that kind of market. More than likely, we're going to end inside of yesterday's price action. That's going to be the base case scenario, especially since yesterday's price is so big, which means we're going to really want to focus on all of the internal pivot points, right? They become a lot more important at this point. So our Globex low, Globex high, the cash open of yesterday, 38.72. The consolidation package around 38.25, 37 or 38.30, right around in there. We can also use measured moves, so capturing all of the Globex. Somehow it doesn't surprise me that 200% of the Globex measurement lands right on a cog line, right on our ADR half, 38.11, 38.10. That's the way things work when you're doing your analysis consistently. It should line up with other data points. So looking at 38.31 and 38.23 after we break through the Globex low, 38.37. Then we've got a cog line at 38.11. The 123 lines up right at yesterday's cash open. Love it when things just line up like this. Now we've got a little bit more to work with. All right, so kind of zoom out a little bit so we can catch all those numbers. 38.94, 38.80, 38.72, 38.54, 38.30, 38.23, 38.11. Beyond those, you would get to yesterday's high, yesterday's low, and then the full market maker move, or excuse me, the full 21-day ADR. ADR plus market maker, and then extreme. So all of our pivots lined up for the day. Remember, it doesn't owe us anything, right? This doesn't owe us a breakout. It doesn't owe us, an expansion anywhere. I was just checking to see if Spot Gamma has come out with their levels. Yesterday, Spot Gamma nailed this thing. So they had 1.29 as yesterday's expected move range. And the way expected move range works when we're dealing with the week-to-week expected move, when we break outside of that expected move and continue to move away, if it's to the upside, they have to buy into buying. If it's to the downside, they have to sell into selling. So they really was fighting to hold it, to keep it inside that box. So once we finally broke out of that box, they really dug in and just went with it. Really sold us down into that reversal. 2-bar flip. Once we began to stabilize and come up off of those lows, they ran it right back to that 1.29. The SPX closed down 1.4 something. So it didn't quite get to the 1.9, but or 1.2, but it was pretty close. So they did a good job running it back. But I don't see that they have today's out yet. Unless you've got a subscription. I don't have a subscription. I'm just checking their Twitter. All right. Yep. That would be a no. Keep your eye on it. It's it's one of those things. If you have an account, you probably get the information a lot faster than the rest of us. But I try to use things on the morning briefing that don't require you to get a subscription to something, right? Like, I mean, yeah, sometimes I use TrendSpider and things like that, but you can do the morning briefing for yourself without having to go out and spend a lot of money on big news services and all that kind of stuff. Finance Juice is free. FX Street, right? Bloomberg 5 things you need to know. So we're looking at a 10-day, 30-minute volume profile with a TPO. We're at that point of control now. As we had talked about yesterday, if we were to drift down the lower, yesterday, this area was where the point of control was at. And there was a pretty significant level of volume down here. All we needed to do was get through that zone, and we were going to bring in the point of control to that new location. That's what we got. So we brought it down. We're at that spot. We're struggling with all of this just like we were talking about, from 38.80 to 38.20. So getting outside of yesterday's range is going to be difficult when we're sitting in the greatest amount of volatility. It causes a little bit of a magnet, but it also is just trash to get through. It's going to be hard to get out of this zone and actually get in one direction or another. If we do get up towards yesterday's high, there's still, that's where the old point of control was. There's still a significant level of volume up there. So 3,900, 3,911, which is a cog line, 3,920, yesterday's high, in that entire area is going to be hard to get through that too. Right. First touch play, we get up there, be a nice, 7 to 10 point reversal play. One touch play. If we do get above that zone, it shallows out. So we don't start running into any real resistance until around 39.80. Another shallow zone, and then 40.60. Now, we're not likely to make that kind of move today. 40.60 is reaching a bit much. Just getting outside of yesterday's range is going to be a bit much. All right, so someone who has access to spot gamma said that today's one-day move is 1.24%. So a little lower than yesterday's, not by much. Yesterday was 1.29, today it's 1.24. Notice this volume point of this virgin point of control that I'm about to delete. When price came down to it yesterday, it responded to it, right? And like I say all the time, these are not support levels, but they are levels where we anticipate price reacting to them. Price reacted to this thing yesterday. It didn't hold it up. Price ended up breaking through it. But if I was looking for a trade and I didn't know that that line was there, and I was trying to take this short after it started to consolidate and pull back a little bit, if I didn't know the line was there, I wouldn't know to be concerned, right? It would just look like we dropped down into this area, consolidated, dropped down, consolidated, dropped down, consolidated. I wouldn't have known that there was something that we needed to break through. So, there's a purpose for carrying these lines forward and then having a way to grasp how we're going to use them. This VPOC, we didn't trade through it. So depending on, how you manage these things, you could take this off. I'm not going to. We didn't trade through it. I'm going to keep it. Keep in mind that price didn't bounce off of that level and run away. It wasn't support, and it wasn't this. That spot, well, in the SPX anyways, on a yearly chart, that's 2021's open. I didn't look at it on an ES, but I bet we're going to get the same answer. Nope, we don't. It's in the middle of nowhere on the ES. On the SPX, oh, it was where we closed. So these are yearly candles, right? And look at the 2021 yearly open, 37.64. That's what I was watching yesterday when we came into that level. All right, after all that running around, the expected move for the week, we hit it yesterday and had a reasonably decent rebound off of that edge. We're still in the middle of the box, still in the middle of the range. The gray line is where we closed last Friday, and we're just a little underneath that. Keep in mind that this reversal candle from yesterday, this really big day, it doesn't fit one of our reversal patterns that we're looking for. It's in the wrong location. It's the wrong size. It's the wrong shape, right? It's not a belt hold. It's not, like a morning star reversal, bearish engulfing. Maybe. Barely from that top side. Yeah, so a bearish engulfing, but just, by the tiniest amount. So a little bit of a line in the sand is that 50% level. Now, you can use your quant tool and break that candle down into 4 pieces, the 25%, 50%, 75%. You can add those levels to what you're already focused on. I'd say I've got enough pivots. I don't need the 75 and the 25. But when I was looking back through 2022, I was looking for a candle like this in a setup like this. And I didn't really find a good example. The main thing is right now is we're absolutely trapped inside of this range. And whether we get out of it today or not, we're still going to have to resolve it next week. So you can carry that forward through the week. Looking at how far away from the 10-day we are, we're still relatively close. We're only 1% away from the 10. That rally back up in the afternoon kind of helped with that. So we're not, quote, oversold. Take it to the 10-week. Still not oversold. All right, we're looking at the ES on a weekly chart. Got a nice rollover after the wedge breakout that we had. Just a nice, clean continuation to the downside. This hopefully shows everything's just unfolding the way it's supposed to. It's a little more violent than we were perhaps expecting, but it's not a surprise. It's doing what it's supposed to do, continuing that move to the downside. Natural gas down nearly 2%. And the China names are up more than 0.5% this morning. So KWEB we'd want to focus on those China ADR names, right? JD, PDD, Baidu, Baba, Neo. Gold's up, Bitcoin. Energy's not quite to our benchmark. Kind of wanted up at least 0.5%. XLE is up, kind of leading the list. But looking at oil and gas exploration, oil services, you know, they're kind of dragging behind. And finance, AMC's getting whacked pretty hard this morning. And crude oil is up 2.5%. We're getting a little bit of a reflexive bounce in Tesla. It's mild, it's not much. Got a 1% bounce up off of that low. And you can see it's already giving it back, right, from that reflexive move. And that was from last night. At 4 o'clock, when everything started to shift this morning, that's also the same time the ES got that move. So here in pre-market, kind of sitting in the middle. Got a whole lot of nothing. I'm sure in the long term, this is still not done. They keep talking about valuations on this thing. And yeah, I mean, it doesn't look good, but it's hard to kind of approach this for a short trade now after it's already fallen so far, right? It'd be better off catching it after a rollover. So the expectation is a rally off of support into a resistance zone and then catch it on the next flip over. It hasn't even turned yet on the daily, so we don't know where to measure for the resistance. Got some moving averages, but you know, they provide depth and context, not a structural level of resistance. Wouldn't want to use them like that. And Meta is getting a little bit, not quite at 0.5% yet. The way that everything tends to work together, most of the names that we're going to look at are going to be stuck inside of yesterday's candle. And yesterday's candle is probably going to be a really big candle, right? I mean, they're all going to basically look like the indexes. When they don't, then at least you know you're playing with something in a different beta, you know, that it may be doing its own thing. Otherwise, the inside day breakout is going to be the benchmark for entry into a lot of things today. So what we're looking at here is we're asking how many names in the NASDAQ are down at least a quarter of a half of a percent. Oddly enough, KWeb is up this morning. JD is down. Oh, I'm not on the down, I'm on the up. All right, well, then that does make sense. So NASDAQ, how many names are up a half of a percent this morning? 7 names. That's not really inspiring. One of them, JD, is often referred to or referenced as the China name. I don't always put that much weight into one single name, but it's interesting to hear him refer to it that way quite a bit. For the S&P, 9 names up at least a half of a percent. And again, not very inspiring. Right? Those financials start to stand out a little bit. JP Morgan, Morgan Stanley. And then the energy names. So what's catching bid this morning? What sectors to really focus on? Definitely energy and financials. That's been my play through most of the year. Intraday is energy and financials. I was looking at Campbell's Soup last night. We had this really beautiful red to green that all just kind of fell apart. And then we were stuck range bound. I know this is like a boring, slow, but look at it on the year. It's looking really good. So we gapped up into this island. If it's going to be an island reversal, it's going to gap back down and join this price action from below. Put it on a weekly, kind of clean it up a little bit. We're coming into this major resistance right there at that $58. This one's definitely worth keeping an eye on. It's not going to be an easy shot. Got a lot of stuff to work through. 2016, 2017, through all that mess. But if we can get above 58 and then validate that as some support, maybe build a base after this expansion that we've really had since, early November, could get a good shot up into the high 60s. But looking at it on the daily, this really looks like a make or break moment. Got a bit of a wedge forming too. NVIDIA on the weekly stuck between the 20 and the 50. And this week it came down and put in a test of that 20 period moving average. You can see earlier in the year when we rejected off of it, now we're through it. We're working on resolving the 50 now. That 20 needs to hold. Semiconductors is not beat down yet like the rest of the market is. But they are on the counter trend list for seeking alpha. If we fail that 20-week, probably have a nice shot to revisit these lows. And yeah, that is a big, really, really big head and shoulders, but it's a weekly head and shoulders, right? It's spent months building this thing, basically all through 2022, building this thing, right? Like that's a whole year worth just to get the head and shoulders to this point. We still need to resolve the right shoulder. And then you could get your measured move, and that would put you up into the 300s, maybe the 320, 340s. But you're talking about all of 2023 to make a kind of move like that. So if you're looking for a counter trend play, kind of bucking the system and taking the other side of the trade, because everybody's pointing out how we're not done falling in the overall market. Things are still going to be rough next year, and semis are the least beaten down sector left, right? They're like one of the last holdouts. So, going short's what everybody's doing. The counter trend that Seeking Alpha pointed out is that it is setting up for a bullish play, but you would be going against the conventional wisdom of everybody out there right now. So kind of keep an eye on it. If this 20 holds and we build the right shoulder, then we're going to look to re-challenge that 50 again, and that'll be the next level to get through, that 170, that 185, 190 area. Certainly looks weak. Looks like it's going to continue that move to the downside. We tangled with the 50 yesterday, and it held as a first touch, as did the rest of the market, right? The rest of the market also has the same big red day with a long wick on the bottom. Now we were talking about range today. Apple's got not only the big day from yesterday, but all week, right? So 135 and 130, that $5 range is going to be significant here. We have to get out of that. So if you're looking for a play in Apple, don't diddle in the middle. Got to get it above that 135, or it's got to get below that 130. If you're looking for a short, the best place would be to get in across these highs, right? That 130 area. And if you're looking for a long, the best place to get in would be along that 130 area. Of course, when does the market actually give us what we want? All right, with Microsoft, we're starting to finally get that breakdown. it's been holding inside of this November candle from 238 to 258 all month. And we finally broke down out of it yesterday, but we rallied back up into it again. So got to watch this thing today, see if we're going to break that level. We could end up chopping into the rest of the day and have to deal with it next week. But we could start to see that rollover now, expanding farther away from that 20-week moving average. And then Netflix counter trend going against the grain. We're still holding above that 50. Very likely we're going to, test it, test the 20, and then continue to work on coming back up again. So far, this name on the Seeking Alpha list for a counter trend trade is looking pretty good. All right, even with the multiplier, you can see all this gray area. Showing that we just have a really flat market out there. We need this catalyst to kick off and break us outside of the edges one way or the other. Breakthrough, breakout to the upside or to the downside. And I don't really care which direction we go, as long as it picks a direction. All right, so the fangs look good. Microsoft, Google, NVIDIA, Tesla, Amazon. Now, my benchmark is 0.5%. So Google meets it, Meta meets it, but the rest of these, Apple showing nothing, Microsoft not at the benchmark. Kind of game it out today. It's very unlikely we're going to see a significant market rally that sticks, but we could see short list, short covering rally, counter trend, bounce off support into resistance. I don't think we're going to see the kind of shenanigans like, a rug pull, a big flip. There's no kind of afternoon economic data to come out this afternoon that should flip the market over or anything like that. And I haven't mentioned it, but lower volume. Even though this is a full trading day, a lot of people are already out the door. They're gone. They're on, Christmas holiday. So we're going to see a lack of regular trading volume. The machines are there, right? Of course. And they make up what, 85, 87% of all the volume traded. So we're going to have that kind of trading, but that's really algorithmic flow, right? There's just not going to be the regular retail interference. So watch the K-Web. Oh, finance on the FX names. Can't forget that. So someone mentioned the other day that the Bank of Japan has a habit of playing around near or on Christmas when it comes to changing things like their bans on their zero interest rate, right? Like they did that the other day. So watch the FX names. US dollar Japan, US dollar China. If things are going to go wild and crazy, it very likely is going to be some FX news, right? It's not, once we get through our econ today, we really don't have any other econ that's going to move the market. But FX news can move the market, and it can get really extreme really fast. So we've got, just this year, we've seen British pound, US dollar shake the entire global space. We've seen US dollar Japan, when Bank of Japan came in and defended that 145, shake the entire global market space. So, we have the capacity today for some shenanigans from this direction, from the FX market. It doesn't have to be Japan. The pairs that I usually watch, Japan, China, Canada, Europe. And recently, I mean, more often than not, it's US dollar Japan. On the intraday, it's the one that I'm keeping track of more than any of the others. All right, so there's our 830 print. Going to test that 3830. VIX hasn't even really woken up yet at all. No rate of change there. That thing is such a turd. Yeah, we got nothing in VIX. All right, so we got all of the levels laid out. You should be ready to go for the day. Be careful, be safe, enjoy your holidays. Remember, the market is closed on the 26th. We're going to open back up on the 27th. And I'll see you all next week.